I'm Julie Marion, founder of the First Time Homebuyer Workshop, and welcome to our discussion of pre-approval letters, fully underwritten pre-approval letters, and pre-qualification letters. Today, we're defining what a pre-approval letter is and is not, and we will be answering why pre-approval letters are different between each bank in terms of what it means, comparing pre-approval letters versus a pre-qualification letter, and then I have a gray area I want to share once we get through these definitions, so stay till the end. Here on this channel, we are all about empowering first-time homebuyers with the knowledge you need to make informed decisions. Because, as you know, there are 5 professions involved in your home buying journey, from bankers to inspectors to brokers, attorneys, and appraisers. Each of them has their own industry standards, certifications, and knowledge you need to absorb. And guess what? You've got to make sense of all of this in a very short time frame. Trying to absorb all of this while making one of the most expensive purchases of your life can leave you feel, well, what I call overwhelmed, which is why we do these short info-packed sessions to help guide you along the way. You're busy, I get it. But I want you to walk away from each episode with one acorn of knowledge before you embark on this huge purchase. It is best to start learning about this about 6 months before you say, I'm going to buy a house, but everyone's journey is different. First-time homebuyer remorse is real, folks, and we have got to blow it out of the water. Over 50% of first-time homebuyers experience it, and as of November 2023, a staggering 92% of homebuyers across the board reported some level of remorse. Something is wrong with our system, but while I can't overhaul the entire industry, what I can do is empower you to make smart and informed choices. I've been there. I thought I knew a lot, and still I made mistakes despite having experts around me. I'm here to make sure you don't make the same ones. That's why I care so much about first-time homebuyers. Now let's dive into today's topic, financial letters. A pre-approval letter is a document issued by a lender, typically a bank or a mortgage company, indicating they have reviewed your financial situation and are willing to lend you a certain amount of money for a mortgage. It's based on a preliminary evaluation of your creditworthiness, income, assets, and other financial information. Getting pre-approved for a mortgage is an important step in the home buying process, as it gives you a clear idea of how much you can afford to borrow. Caveat here, I will address this a little later, and the letter that is submitted with your offer to purchase. Most of the time, the sellers will not accept an offer unless a pre-approval letter accompanies the offer. A pre-approval letter is not a guarantee of a loan. It's conditional upon the information provided on the loan application, the credit check is accurate, and the borrower meets the lender's underwriting requirements. Pre-approval letters can vary between different banks and lenders because each institution has its own specific criteria and process for evaluating borrowers. Here are a few reasons why pre-approval letters might differ. 1. Criteria for evaluation. Each bank will have slightly different criteria for assessing a borrower's financial situation. While one bank may place more emphasis on a credit score, another may prioritize income stability or debt-to-income ratio. This criteria is determined by the board of the bank. Number 2, internal policies. Banks have their own internal policies and risk assessment frameworks. These policies may dictate the maximum loan amount they're willing to pre-approve a borrower, as well as specific conditions or requirements. These internal policies are determined by the board of the bank. Number 3, the underwriting standards or the guidelines used to assess a borrower's creditworthiness varies between lenders. Some lenders may have more stringent underwriting standards than others, leading to differences in the pre-approval process. These underwriting standards are determined by the board of the bank. Number 4, market conditions. Lenders may adjust their pre-approval criteria based on prevailing market conditions, such as changes in interest rates, housing market trends, or economic factors. This can influence the level of risk they're willing to take on and consequently the terms of the pre-approval they offer. The risk of the market conditions are determined by the board of the bank. Number 5, technology and tools. Different banks may use different technologies and tools to streamline the approval process. Some may have more advanced algorithms or automated underwriting systems, which could affect the speed and accuracy of their pre-approval decisions. So their overhead costs may be different at each bank. Overall, while the basic concept of issuing a pre-approval letter prior to a formal loan application on a specific property remains a consistent benchmark in the lending industry, the specific terms and conditions outlined in pre-approval letters can vary for each institution. Sometimes big international banks only issue pre-qualification letters, and this type of letter showing the seller your creditworthiness is oftentimes difficult to get your offer accepted, and that's because a pre-qualification letter is not a formal review. You can pre-qualify yourself in your own home. A pre-qualification letter does not require verification or validation of the information provided by the borrower, as it has been verified by the lender. It's a cursory assessment based on self-reported data. It provides a general idea of your purchasing power, but it does not guarantee a loan. It's an informal estimate and does not signify a lender commitment. As students in the first-time homebuyer workshop, we go through this process in week 1, so you have a general idea of your buying power. But an official review is the pre-approval letter. The pre-approval letter focuses on your financial profile as it relates to the mortgage eligibility, and there are 7 areas of review: income verification, debt-to-income ratio, DTI, asset verification, credit history, residual income, loan-to-value ratio, and employment stability. Now, don't worry about taking notes. In the show notes, I have a cheat sheet for you to go and grab on our website so you can start to gather this information. Let's go through number 1, income verification. Lenders will assess your income to determine your ability to repay the loan. They may request pay stubs, W-2 forms, tax returns, and other documents to verify your income. Number 2 is your DTI, your debt-to-income ratio. Lenders calculate your DTI ratio, which compares your monthly debt payments to your gross monthly income. A lower DTI ratio is generally favorable for mortgage approval. Number 3 is your asset verification. Lenders may also look at your assets, such as savings, investments, retirement accounts, to ensure you have enough funds for a down payment and closing costs. Number 4 is your credit history. Your credit history and your credit score are significant factors in the pre-approval process. Lenders will pull your credit report to evaluate your payment history, your outstanding debts, and your credit utilization. Your credit history provides insight into your past financial behavior and your ability to manage debt responsibly. Lenders use your credit score and your credit report to assess your risk level and determine your eligibility for a mortgage. Number 5 is your residual income. Some lenders also consider your residual income, meaning if you live below your means, the money that you have left over after paying all of your monthly debts and expenses. This helps ensure that you have sufficient funds to cover unexpected expenses and emergencies, in addition to your mortgage payment. Number 6 is your loan-to-value ratio. Lenders also consider the loan-to-value ratio, which compares the amount of the loan to the value of the property. A lower LTV ratio may result in more favorable loan terms, as it indicates less risk for the lender. So if you put down a 50% down payment, the risk to the lender in the case of a foreclosure is relatively low, because the lender most likely would be able to sell the property even if the market tanked. Number 7 is your employment stability. Your employment history and stability are important factors in the pre-approval process. Lenders prefer borrowers with steady income and employment as it reduces the risk of default on the mortgage. While a pre-approval letter doesn't typically involve a detailed examination of your day-to-day spending habits or budget, lenders do consider your overall financial health and ability to manage debt responsibly. It's essential to be prepared to provide accurate financial information and demonstrate your ability to afford the mortgage payments based on your income, your debts, and your assets. Additionally, it is wise to have a solid understanding of your personal budget, how a mortgage payment would fit into your overall financial picture. A pre-qualification letter is a completely different animal. It provides an informal estimate of your borrowing capacity based on self-reported information, while a pre-approval letter involves a more rigorous evaluation by the lender and signifies a higher level of commitment. Pre-approval letters are generally more valued by sellers and real estate agents because they demonstrate that you're serious and that you're financially qualified as a buyer. So let's delve deeper into the differences between the pre-qualification and the pre-approval letters. Number one is, of course, as we've been alluding to, the depth of evaluation. Pre-qualification, this process involves a basic evaluation of your financial information provided by you, such as your income, your assets, and your debts. The lender uses this information to estimate the mortgage amount you might qualify for without verifying the accuracy of the details provided. A pre-approval, in contrast, requires submitting comprehensive documentation, including the pay stubs, W-2 forms, the bank statements, tax returns, and authorization for a credit check. That's the big thing, the credit check. The lender meticulously reviews this information to verify your financial status and assesses your creditworthiness. Number two, secondly, the difference between the two would be in the area of the level of confidence. Pre-qualification provides a rough estimate of your borrowing capacity based solely on the information that you provide. Since there's no verification process, the lender's confidence level regarding your ability to secure a loan is lower. A pre-approval, on the other hand, signifies a higher level of confidence from the lender by conducting a thorough review of your financial documents and credit history. The lender is more assured of your eligibility for a loan within specific range or amounts. They know that your credit score, your income, and your DTI. Number three, we need to evaluate the quote-unquote seller perception. Pre-qualification, sellers and real estate agents may view the letter as less reliable compared to a pre-approval letter. And a pre-approval letter carries more weight. Number four would be the time frame. A pre-qualification, since the pre-qualification relies on self-reported information and doesn't involve any verification steps, it can typically be obtained relatively quickly, sometimes even during a brief phone conversation with a lender. A pre-approval letter, obtaining one, it usually takes longer due to the comprehensive documentation and verification process involved. However, the extra time and investment is often worthwhile as it provides a more accurate assessment of your financial readiness and strengthens your position as a serious buyer. All of this seems pretty straightforward, but here's the gray area and where it can get a little dicey for you as a first-time buyer. For example, a pre-approval letter does not look at your budget. So let's say you have an expense that is not reflected in your debt. Maybe you help your parents each month, and that's a non-negotiable expense, yet it doesn't show up on a loan or a credit card. Or say you have a family house where you are participating in the maintenance of the house and ongoing expenses, and you are personally obligated. Again, it's not reflected on any debt or say, a credit card. Or say you drive an old car that starts breaking down, or you need to start medication that's not covered by insurance, or you have a four-legged pet that requires daycare or boarding when you are away, and those really inexpensive vet visits, or maybe you have children expenses. A pre-approval letter typically doesn't delve deeply into your personal budget in the same way that you might when you're managing your finances day to day. So how does a bank know if you have budgeted correctly for the length of the mortgage, meaning 15 or 30 years? The short answer is they don't. They only look at you and your finances based on their business model, and the rest, the personal expenses, your life expenses, they're up to you. They also are not looking at inflation, the property tax increases, and the home maintenance expenses, or anything in the future. And I ask you, when has pay raises ever kept pace with inflation? Everything up to the closing, they're basing that on a snapshot in time. Once the bank closes on the loan, your whole financial picture can change. As long as you make your payments and pay your taxes, the banks will be satisfied. Now, a fully underwritten pre-approval letter is a complete financial review of you, the borrower, and that review has been completed by the underwriting department. All the bank needs is a satisfactory appraisal, and the transaction can move forward to closing. It's an extremely powerful letter that accompanies your offer because the seller knows the bank is ready to fund your mortgage, barring any issue with the home price. It is the strongest letter a buyer can obtain for financing. So does a pre-approval letter with a 40% down payment beat out a fully underwritten pre-approval letter with 10% down? Well, that is in the eye of the seller. Most likely, the other terms will play a factor. Homework. Yes, you have homework. I want you to start noticing what the Federal Reserve is talking about. Notice when their meetings are coming up, what reports are being released on the economy, and the dreaded word, inflation. This will be impacting you on your immediate needs for obtaining a mortgage. And it's all around. You just may be so busy that you haven't noticed. There you have it, an acorn of financial knowledge to put in your home buying jar. In the next episode, we are going to be discussing the Federal Reserve and how they influence your interest rate. Until next time, from the team at the First Time Homebuyer Workshop with Julie Marion, bye for now.